Okay, dear students, this is Mustafa Mirchawala, your FR trainer, and today we are going to discuss the latest past paper questions of ratio analysis, okay, interpretation of financial statement before of September December 24 attend. Before we move on, just for your motivation, the latest results you can see marks in 80s, 70s, 60s. It's a big list, and this is our routine. Like this is December 24. If you see September 24, June 24, this is our routine. Okay, and this is because the students follow the instruction of these are the students, they follow the instruction of me. Okay, so without wasting a single minute, let's jump onto the past paper question of ratio analysis. Okay, so we have uh, this scenario relates to three requirements. Now we have three requirements in this question. Yes, there is a ratio analysis question, but the good news is a 5 mark easy consolidation is there, and then you have 5 marks just number crunching ratio analysis question like calculation, and then you have 10 marks commentary. So very fair question. Okay, first we'll approach the consolidation part. Okay, the directors of clocking is the basically the parent company. Its parent company purchased 80% of 100 million shares. That means 100 million multiplied by 80%, it's 80 million shares. So first thing, parent company bought 80 million shares of S company, stopping company. Parent company bought 80 million, 80% shares of S company. Be careful. On 1st April X8. Now wait. If you see the year end is 30th September, year end is 30th September, and definitely here you have X8. So if you see the year end of 30th September X8, 1st April X8 is exactly the mid of the year. Wait, let me show you. If your year end is 30th September X8, so that means it is starting on 1st October X7. Okay, see, if the year end is 30th September X8, that means it's starting on 1st October X7. So this date, the 1st April X8 is exactly mid of the year. This date is exactly mid of the year. Okay, so we acquired this company exactly on the mid of the year, right? So it's a mid-year acquisition. 1st April is exactly mid of the year. It's exactly mid of the year, right? Okay. Now we need to calculate with the first. I will show you the first requirement. We just need to calculate the goodwill. Okay. And goodwill is calculated at acquisition date. We all know. So we need complete cost of investment, whatever consideration we are paying to acquire this subsidiary, all considerations plus acquisition date net asset packet. Definitely holding is 80%, so fair value of NCI is also required, so don't worry about it. Now the consideration comprise of a 1 for 4 share exchange. That means for every 4 shares, for every 4 shares coming from the subsidiary, we are going to give one. See, for every 4 shares coming, we have to give 1 share. So the fraction will be 1 upon 4. Fraction will be 1 upon 4. 1 upon 4 of the number of shares, that is 80 million. 80 million into 1 upon 4. So 80 million into 1 upon 4 means 20 million. That means parent company is going to issue, parent company is going to issue 20 million shares. Parent company is going to issue 20 million shares as a consideration. Okay, so this is the first consideration. Then there was also an immediate cash payment of 2.8 per share. Very easy. Use your brain. We have just bought 80 million shares of subsidiary company. So for 1 share we are paying 2.8. For 1 share we are paying 2.8. 1 share we are paying 2.8. So 80 multiplied by 2.8. 80 multiplied by 2.8 will, this will be your cash consideration. Now the third thing is a further 2.7 per share is payable on 1st April X9, like after 1 year. The takeover date is 1st April X8. So after 1 year we are going to pay 2.7 per share. This is called deferred consideration. This is called deferred consideration. And we all know deferred consideration is recorded at present value. So the difference between 1st April X8, 1st April X8 is the takeover date, and the payment date for this deferred consideration is 1st April X9, exactly 1 year. So we need to do discounting for 1 year. We need to do discounting for 1 year. Don't worry about it. I'll show you how to do it. Okay, don't worry about it. Then now they have given you the market prices. On 1st April X8, the market price of each share in clocking is parent company. This is 12.5 per share. Why they have given you this? Because we need to use this in shares consideration. We need to use this in shares consideration. Okay. And then they have also given you the share price of subsidiary. Now the question is, why they have given you the share price of subsidiary? Why they have given you share price of subsidiary? Because we need to calculate fair value of NCI. You already know, you have done the questions. Sometimes examiner gives you ready made fair value of NCI at acquisition, and sometime examiner gives you the share price. Sometime examiner gives you the share price of S company, and you calculate fair value of NCI through share price. You calculate fair value of NCI through share price of S company. Okay, number of shares of NCI multiplied by share price. Very normal thing. Okay, now the last thing. The retained earning of stopping company at first, stopping is subsidiary. At first October X7 is 610. See, at the beginning of the year, the retained earning is 610 million. At the beginning of the year, the retained earning is 610 million. Now, how we have to move forward? This is the beginning of the year. Okay, so we have to calculate profit of 6 months. We need to calculate profit of 6 months. Okay, so they are saying, and the company reported a profit for the year ended 30th September X8 is 88. So for the whole year, profit is 88. 88 into 6 upon 12. 88 into 6 upon 12 is 44. 88 into 6 upon 12 is 44. Okay. So that means 610 plus 44 will give you the retained earning at the date of acquisition. It's I think 654. Yes. So at the date of acquisition, the retained earning is 654 of S company. One more thing. Ordinary share capital we already know. See, this is the ordinary share capital. See the screen. This is the ordinary share capital, which is 100 million. Ordinary share capital is 100 million. Okay, so that means 754. This is the net assets packet. This is the net assets packet of S company. Now the last thing, they have given you the group policy of valuing non-controlling interest at acquisition at fair value. See, so yes, it's a full goodwill method, and we need to calculate fair value of NCI. And for the fair value of NCI, they have given you the share price of S company. They have given you the share price of S company. Okay, now last thing, why this cost of capital given? Because for deferred consideration, we need to do discounting. For deferred consideration, we need to do discounting. Okay, so I would say it's a ready 5 marks, ready cash 5 marks for you. Cash 5 marks for you. Now, what they are saying, calculate the goodwill on the acquisition of stopping company. 5 cash marks, just practical 5 marks. Practical 5 marks, easy peasy, very easy, very easy. Okay, so let's start. First, my request is, if you want to take the picture of this part, take the picture, because I'm going to move the screen a little bit. Okay, I'm going to move the screen. See, you can take the picture. So I have the question with me on my other screen as well. So we have requirement number A. Goodwill calculation. Please whatever lecture I just gave you, keep that thing in mind and see the question. You have the picture of question, you'll do it. Or I would recommend pause the screen, try the goodwill calculation yourself and then tally with me. So you have COI. Number one, the first thing is shares consideration. Shares consideration. Now very easy. Total shares S company issued was 100 million multiplied by 80%. This is the shares which we just bought from S company. These are the shares we just bought from S company. Now 1 for 4. 1 for 4 was the deal. So 1 upon 4. So 100 million multiplied by 80% is 80. 80 million into 1 upon 4 is 20 million shares. So as a consideration, as a price, parent company is giving 20 million shares to S company's existing shareholder, and the share price for one share is $12.5. Share price for one share is $12.5. So this will be 250 million. This will be 250 million. Okay, so shares consideration is there. Now next thing is cash consideration. This is the super easy thing. Next thing is cash consideration. Okay, how to do cash consideration? Simple. 100 million was the total shares issued by S company, and we just bought 80%. So 100 million times 80% is 80 million. That means we bought 80 million shares of S company. And how much we are paying per share? For one share we are paying 2.80. So this will be 224. This will be 224 million. This will be 224 million, right? Next thing is deferred consideration. Very easy. Deferred consideration. First calculate how much cash we have to pay after 1 year. How much cash we have to pay after 1 year, then I'll do discounting, don't worry. So 100 million shares multiplied by 80%. Okay, so that means 80 million shares we have bought. So we have to pay, if we have to pay per share payment, so we have to pay on 80 million. And how much we have to pay on per share? It's 2.7. Yes. So this is the total amount. This is the total amount we have to pay after 1 year. This is the total amount we have to pay after 1 year. Now do discounting. How to do discounting? Divide. See, this is the division sign. 1.08 power 1. Divide by 1.08 power 1, or you can write like this, into 1 upon 1.08 power 1. Both things is correct. You can directly divide this whole number with 1.08 power 1, or you can do into 1 upon 1.08 power 1. Both thing is easy. Okay, let's do it. So this will be 200 million. Okay, so these three makes your COI. These three makes your COI. The next thing is fair value of NCI at acquisition. The next thing is fair value of NCI at acquisition. See, fair value of NCI at acquisition. Now just think, out of 100 million, we bought 80 million shares. Out of 100 million we bought 80 million shares. So that means 20 million shares are owned by NCI. 20 million shares are owned by NCI. And what is the share price of per share of S company? It's I think $8. It's I think $8. So 160 million is the fair value of NCI. Okay, so if you add all these, it will become 834. If you add all these for 834, and now this is equal to 100%. Okay, now let's do less fair value of net assets of S company. Now wait, right? So we made the packet. Ordinary share capital is simply 100 million. Retained earning at the beginning of the year, was 610 plus 88. 88 was the full year profit into 6 upon 12. Remember, right? So you will have a retained earning of 654. So if you add these two, 100 plus 654 is 754, right? So now take the difference, you will find the goodwill. That's it. 80 is your goodwill. 5 easy, 5 easy, crystal clear marks. Easy marks, I would say. No difficulty. Simple, he tested different types of consideration, the treatment, and then the fair value of NCI, and then finally acquisition date. Even there is no fair value adjustment. Even there is no fair value adjustment at all. You guys have done fair value adjustment as well. You guys have done fair value adjustment as well. Okay, I'm sure you guys understood it, and you did, some of the students did this thing themselves as well. Now let's move to the next part. See, this is the consolidated profit and loss. What does it means? In 2007, the previous year, parent company was alone. Parent company was alone. Okay, wait. This time parent company was alone. Now in 2008, mid of the year, a subsidiary came. So this is combined. Now first, criticism. In this question, in the end, you will get 2 marks for the criticism or limitation. The 2007 year is only parent company. Is in 2007 parent company was alone, but in 2008 parent plus subsidiary in mid of the year, especially mid of the year. So this comparison is not like with like. This, if you compare 2007 with 2008, this is not like with like, because last year in 2007 there was no subsidiary at all, but now you have a subsidiary. So this comparison is not like with like. Okay, this is the limitation you will write. Now, and then you have this SOFP, only SOFP equity side. This is your complete equity packet, and this is your non-current liabilities. And you know that if you want to calculate capital employed, quick thing I'm telling you, capital employed, as there is no assets given in this question, so capital employed will be calculated using this formula: shareholder equity plus non-current liabilities plus non-current liabilities, shareholder equity plus non-current liabilities. This is the formula of capital employed, we all know. So let's calculate capital employed here. Capital employed for 2008 is, this is shareholder equity. Listen, this is your shareholder equity and this is your non-current liability. So 1168 plus 387, 287 plus 387, this total, if you add these two, this will be your capital employed. It's I think 1555287 for this year, and then for the next year it is 956305. Just this thing will help you. Out. Okay, so the formula for capital employed is shareholder equity plus non-current liabilities. Shareholder equities plus non-current liabilities. Okay. Now, we all know that the acquisition date was mid of the year. Now, read something. All profits are accrued evenly throughout the year. Okay, that means the profit should be 6 upon 12. If you want to land directly at the mid of the year, it should be 6 upon 12. Okay, clocking company has suffered. This is the parent company. Now you will listen the story of this question, because you have to do the commentary. Clocking, the parent company has suffered from decreased revenue in recent years, which directors believe is mainly due to general economic downturn. The economic conditions are not good. That's why they are saying that there is a downfall in sale. The falling sales were the main reason for the investment in stopping company, so that clocking company have more control over its competitor. Yes, got it. So that means this subsidiary was basically the competitor of parent company. So in order to finish this competition, just acquire your competitor and become healthy okay, right? So that's why they did this move, to encourage customers to continue purchasing from clocking company throughout the economic downturn. Yes, when there is economic downturn, then you need to decrease the prices. many products are now being sold at significant discounted prices. So I will use this point for margin commentary. You know, we all have done in the class, in my YouTube classes, it's videos, I have also said this. Whenever examiner asks about the give the hint of discount, that discount means sell reduction in selling price. So this is the reason why GP margin and profit margins are going down. In this question we'll see, I'll calculate, don't worry. We'll see that if the margins are going down, if the margins are going down, then this is the reason why the margins are going down. This is the reasons for margin to go down. This is the reason for margin to go down. Okay, right? To assist in generating future revenue, clocking company raised additional finance in September X8, very end of the year, okay, by issuing 25 million loan notes. Okay, now this point will help you discussing the gearing. You know, when you take loan, your gearing increases. So if the gearing in this question is going up, you can discuss this point as well. Okay, right? Now, using the group's consolidated financial statement and pre-formatted table provided, calculate the following ratios for the year ended 30th. Okay, very simple. See, simple, verify again, cash 5 marks, again cash 5 marks. They are saying just from the consolidated financial statement, means whatever financial statements are given to you, whatever financial statements are given to you, they are consolidated. Just use that and calculate all these things: GP margin, operating margin, return on capital employed, net asset turnover, gearing, and interest cover. Okay, and yes, be careful, the formula for gearing in this question is debt upon equity. Debt upon equity, this is also sometimes we call debt equity ratio. Okay, I have a request, again pause the screen, try these six ratios yourself. If you do it, that means you again scored 5 marks, okay. So see, this is the reason, this is the latest past paper nowadays. As I must say, I'm saying this with confidence that students clear F7 paper easily. Those who have taken the classes, those who are doing mocks, and those who are doing properly, they can easily clear the papers. You can see the level of difficulty. This is the latest past paper. Okay, so I would say please take the picture of these two parts. Please take the picture of these income statement and SOFP so that you can easily, because I won't be able to move the screen more. So the request is, now let's do ratio analysis. Requirement B. Okay, wait, let me check the alignment. Okay, so we have the first ratio of GP margin, right? We all know GP margin is GP upon sales. This is going to be our working. This is the 2000x8. Then again we'll do working, and this is 2000x7, right? Okay, so GP margin is gross profit upon sales. Please see the question. I have the question on my other screen. You also have taken the picture. Let's do it. So gross profit for 2008 is 157.25. I'm doing in millions. Okay, so 157.25 divided by sales is 418 million, multiply by 100, this will give you 37.6%. 37.6% for 2008. Now let's do for 2007. For 2007, you have a gross profit of 158, you have a gross profit of 158.52 divided by 340.4 times 100, so this will be 46.6%. Now clearly see, clearly very easy commentary we can do now. Your GP margin came down from 46.6 to 37.6. Your GP margin came down from 46.6 to 37.6. What is the reason? The reason is economic downturn, and yes, you have reduced the prices. You have reduced the prices. So whenever the prices go down, margin also goes down. We know this. Okay. Then we have operating margin. Operating profit margin means PBIT. PBIT upon sales into 100. PBIT upon sales into 100. Go and see the check the question. So you have the PBIT of, yes, it's 96.77 and this. Okay. I'm using millions now. So it's going to be 96.777 million divided by sales is 418 multiplied by 100. So this will be 23.2%. Okay. Now go to 2007. It's going to be 101.482. I'm doing in millions. In the question, it is written in thousands. Divided by sales for this year is 340.4 into 100, which is 29.8. Now, the difference between, see, just for the commentary purpose, GP margin came down from 46.6 to 37.6. It's like 9%. But operating margin went down by only 6% or something. So the reason is the expenses are in good control. It looks like till GP the performance deteriorates, but till profit PBIT the effect is little low. The effect is little low. Okay. Now the next thing is return on capital employed. Return on capital employed, ROCE. The formula for return on capital employed is PBIT divided by capital employed into 100. So PBIT is 96.777 divided by capital employed. In this question I showed you, see, this is the capital employed. See, this is these two are the capital employed. You can see shareholder equity plus non-current liabilities, shareholder equity plus non-current liabilities. Okay. I'm going to apply this formula. You have already taken the picture. So it will be 168.287 plus 387. Okay. Multiply by 100. See, in the denominator we have the capital employed. I have already explained you. So it's going to be 6.2%. 6.2%. Now for the here you have the PBIT of 101.482 divided by capital employed is, the capital employed is 852.305, 852.305 plus 104. Okay, multiply by 100. This thing will give you 10.6. Okay, so again your your return on capital employed also went down. Your return on capital employed also went down, which shows ROCE shows the efficiency. So that means the efficiency is also going down. Efficiency is also going down, right? Then we have asset turnover. Right? The formula for asset turnover is sales upon capital employed. Sales, simple. See, easy formulas. The formula for it's sales upon capital employed. Okay, so your sales is go and check the question. Your sales is 418 divided by capital employed is divided by capital employed is 1. I'm directly writing capital employed now, 155.287. see here I have calculated. See, here I have calculated, so I'm directly using. So it's going to be 0.27 times. It comes in times. Okay, asset turnover always comes in times. Then we have Sales is 340.4 divided by capital employed is, here we have capital employed of 956,305. 956.305. See, this thing this thing is your capital employed. I have already calculated. So here it is 0.36 times. Now let's connect the dots. Let's connect the dots. See, your return on capital employed was previously 10.6%. Your return on capital employed was previously 10.6%. Now it is only 6.2. So return on capital employed went down. Return on capital employed went down, and I have taught you these things in class, that return on capital employed is the product of return on capital employed is the product of asset turnover and operating margin. Asset turnover and operating margin, see, both of them are going down. Asset turnover also went down from 0.36 to 0.27, and operating margin also went down from 29.8 to 23.2. So in the commentary section, these are your easy marks. These are your easy marks. You need to inform examiner that return on capital employed came down. Return on capital employed came down because the asset turnover and operating margin came down. Asset turnover and operating margin came down. Okay. So now last thing is, I think, interest. No. After this we have gearing. Yes, gearing. And in this question, gearing means debt to equity ratio. Gearing is basically debt divided by equity into 100. Debt to equity ratio. Very easy, very easy. So your loan was 387. Non-current liabilities were 387. See, I have picked from here. And your shareholder equity was 1168.1 no, it's 1168 million, 0.287, your wish, into 100. So this will be 33.1%. Your gearing is 33.1% in 2008. And if we come here you have non-current liabilities of 104 divided by shareholder equities 852.3, just into 100. So this will be 12.2%. Now, a significant increase in the gearing. A significant increase in the gearing we can see. So we can comment that gearing increases financial risk of the entity. And why this gearing increase? You can give the reasons, because they have taken loan as well. They have taken loan as well. Okay, right? Then finally, you have interest cover. Finally, you have interest cover. Interest cover, the formula is PBIT divided by interest expense. PBIT divided by interest expense. So what is the PBIT in this question? 96.777 divided by interest expense. Go and see the question. Go and see the question. It's 10.067. It's 10.067 because everything is in million. So this will be, oh sorry, let me write here, 9.6 times. Okay, and then you have 101 101.482. This is the PBIT divided by interest expense. Here is 3.187. 3.187. This will give you 31.8 times. So yes, a significant reduction in interest cover. Interest cover is interest paying ability of the company. Interest paying ability of a company. Interest paying ability of a company. Okay. So my dear student, yes, there is one topic which we normally teach. I normally teach that there is a interconnection between interest cover and gearing. There is a inverse relationship. There is an inverse relationship between interest cover and gearing. Whenever interest cover goes up, gearing goes down, or you can say when gearing goes up, interest cover goes down. Okay, so exactly you can see this relationship, that your gearing is going up and your interest cover is going down. Interest cover is going down. Exactly these things you can see. Exactly these things. So we have just done the 5 marks. We have just done the 5 marks. Hope you also did like me, because I told you to pause the screen and try it yourself. Okay, but I don't think anybody of you did mistake, and this was ready. No adjustments are even required. Even in the previous past paper, we did more difficult question than this for calculation purpose. Okay. Now finally, let's come to the last requirement of 10 marks. Analyze. So now they are saying the last requirement, the most important requirement, is analyze the comparative performance and gearing of C. The comparative performance normally profitability ratios. Okay. Then gearing of clocking company for the year 30th September X8 and X7, and comment on the limitations of the ratios based on the C limitations regarding this question. Okay, now they are saying that a maximum of 2 mark may be awarded on limitation. So out of 10 marks, like 2 marks you will get on limitation, so remaining 8 marks is left. For 8 mark, 1 mark is for conclusion. 1 mark we'll get for conclusion, so remaining 7 marks for commentary. 7 marks for remaining commentary on profitability and gearing. Okay, you got it? You got it? Out of 10 marks, 2 marks for limitations, 1 mark for conclusion, and 7 marks for the profitability and gearing ratios discussions. Okay, so yes, you can see, if you want to take the picture, you can take the picture of these ratios. We can discuss, like, see, your GP margin is going down. Your GP margin is going down. So margin is going down because there are economic problems, as well as they reduce the price. And whenever we reduce the price, selling price, the margin goes down. But yes, one more thing, according to law of demand, whenever you reduce the price, if your product has got high elasticity of demand, I'm using the terminology of economics. If you reduce the price and your product has got high elasticity of demand, so your quantity demanded will go up, people will come. When you reduce the price, people will come. Okay, so let's see what about their sales, whether their sales went up or not. Their sales went, yes, their sales went up. Their sales went up. But again, one of the reason for increase this sales, that in 2008 we have P plus S. The 2008 income statement is P plus S, and in 2000 it's only P. So this is also the reason. This may be also the reason, right? Okay. Well, then one more thing. Then you can discuss about the return on capital employed. Return on capital employed is going down from 10.6 to 6.2%. So ROCE shows the efficiency. You can write these dialogue. ROCE shows the efficiency. Sorry, your efficiency is going down. And ROCE, I just told you, ROCE is the product of asset turnover and operating margin. So both operating margin and asset turnover going down. Both operating margin and asset turnover going down. Okay. Now operating margin is going down because one of the reason is the GP margin, the prices. One of the reason is prices. But I just told you operating margin is not going down with the same speed as the GP margin is going down. GP margin went down from 46.6 to 37.6, like 9% down. But operating margin is only 6% down. So this also reflects that there is some control on the expenses. But one thing we can also write, in 2008 you acquired the company. In 2008 you acquired that company, and in the consolidation chapter I have taught you that the acquisition expenses goes directly in the P&L. Acquisition expense goes directly in the P&L. So despite of those expenses, still the expenses are in control. Despite of those expenses, still the expenses are in control. Let me use Urdu language for this. देखें 2008 में एक एक्विजिशन की जो कॉस्ट होगी वो भी तो पीएनएल में जाती है ना, टेक ओवर एक्सपेंसेस. तो उसके जाने के बावजूद आपके एक्सपेंसेस कंट्रोल में, इसका मतलब वाकई एक्सपेंस का कंट्रोल अच्छा है. सॉरी, देयर आर सम स्टूडेंट्स फॉर उर्दू हिंदी. There are many students for Urdu Hindi. That's why sometime I use both language twice. Okay. Now, so right now my objective is not to teach you typing. That's not. I'm not a teacher who teaches you typing. Okay. So in order to go smartly, in order to save time, I have written the points, and I'll teach you with marking scheme. Like I'll tell you how you will score one mark per point, 1 mark per point. This is the best strategy. 1 mark per point. Listen, see this. See this. Very simple. Relax. The gross and operating profit percentage across the 2 years have fallen. Yes, they came down. Seems reasonable given view of management that economic downturn. Yes, one reason is economic downturn. Has led to significant discounts to maintain volume. Yes, 1 mark. Right? So because of economic downturn, we reduce the price, and whenever you reduce the price, margin goes down. Very simple and clear. 1 mark. There has been an increase in sales. Yes, we just saw from the income statement. Okay. Despite the economic downturn, showing that the discounting strategy is working. Yes. Just see. If you give discount, still there are no increase in sale. That means it's very dangerous. But if you are giving discount and people are coming to you, that means your strategy is working. And that the extra financing raised through the loan note is being put to good use. Okay. That means if we are doing marketing campaigns with the loan, so we are on the right track. So 1 more mark. Then this point I have already discussed with you. Operating margin has not fallen as much as gross profit with the same speed. Operating margin did not go down with the same speed as GP margin, suggesting that the companies have good control on operating expenses. This is surprising, as the group is likely to have incurred fees because of the purchase of stopping company. Takeover expenses goes in P&L. I just taught you. So this is 1 more mark. And then you have ROCE. Capital employed is the product. Sorry, this is my mistake. ROCE. Okay, return on capital employed. I have written only capital employed. I typing mistake. Return on capital employed is the product of asset turnover and operating margin. The fall in the operating margin and the reduction both in the across the 2 years, the group has suffered fall in operating profits and an issue of share capital consideration alongside the consolidation of stoppings retained earning. Yes, listen. Why return on capital employed went down? First thing, ROCE, ROCE is the product. Let me write this formula. ROCE is the product of asset turnover and operating margin. Asset turnover and operating margin. ROCE is the product of asset turnover and operating margin, right? Okay, so both of them going down, you just saw it, both of them going down, so ROCE will definitely go down. Okay, one reason. Second reason, ROCE, the formula of ROCE is PBIT divided by capital employed, divided by capital employed. Just use your brain. PBIT divided by capital employed, and capital employed means shareholder equity plus non-current liabilities, shareholder equity plus non-current liabilities. So you, as the parent company issued new shares, parent company issued new shares during the takeover, there was a shares consideration, there was a shares consideration. So that's why your capital employed also went up. That's why your capital employed also went up, because of the share consideration, right? Okay, so that's why your ROCE, the denominator will go up and your ROCE will go down. Your ROCE will go down. So these are the reasons. These are the reasons which we need to discuss. These are the reasons. So see, dear student, we scored 4 marks. We scored 4 valuable marks. We scored. This is how you follow the marking scheme. This is how you score each and every mark. So one question normally student ask, they say, sir, can we change the wordings? Yes, you can use your own words. My words and your words cannot be same. Everybody has got the different style of communication. It's perfect. It's perfect. Now gearing. Now wait. If you see your non-current, see the question. Your non-current liability was previously 104 and it came up to 387. 104 to 387. From 104 to 387, it's a big change in loans. Now wait. Yes. Don't sleep. Non-current liabilities have increased from 104 to 387. That means $283 million. $283 million. But in the question it is written we have taken additional loan of 25 million only. In the question, the notes of the question, it was written that we have taken just before the year end. Just before the year end, we have taken a loan of 25 million. But if you go to SOFP, there is an increase in loan of 283 million. So that means other than this loan, we have taken all other loans as well. Besides these loans, we have taken other loans as well. Or there may be a reason. Listen, you have in 2008 parent and subsidiary, you added both parent and subsidiary. So it is possible that with subsidiary company balance sheet, there are abnormal loans. With subsidiary company SOFP, there are abnormal loans, and that's why the loan of the group, the gearing of the group went up. These are the reasons. Read it. 25 million of which relates to new loan notes issued to finance future operations. This means there must be some think over it, some other borrowings raised by clocking company whose info not given in the question. Now, some existing borrowing and associate finance cost could have been included in the accounts of stopping company. Yes, there is a possibility that subsidiary itself brought some loans. We add together parent and subsidiary. So in the class we have done, if subsidiary is already highly geared, it will ruin the whole group image. This may be possible, and is now being consolidated. Clocking companies consolidated. Consequently, the gearing ratio has increased from 12.2 to 33.1. We have seen. But can you see the wordings? See, could have been. They are not saying that it's confirmed. Even in the class, I sometimes teach this, that always use the word maybe, might be. Okay, because you have not seen the SOFP of S company in this question. You have not seen the SOFP of S company in this question. So you are discussing something which is not in front of you. So the language should be maybe, can be, could be. See, examiner, I have written could be, could, right? Okay, be careful. Now, there has also been an increase in the issued share capital due to the share exchange for funding. But yes, parent company issued new shares, but that was a small part of consideration. Parent company did many consideration like deferred consideration, cash consideration, and shares consideration. So shares consideration was the small part. You see the consolidation part. But the issue of shares is a small part of total consideration. Clocking company may have been better to have negotiated for more of the consideration to be in the form of share exchange, as it now has a liability to fund a deferred payment on 1st April X9. See, we all know that issue of shares raises your equity. Issue of shares raises your equity, will ultimately reduce your gearing. So if the directors were smart, then they should have made the deal of more shares and less cash, more shares and less future cash, because in this way your liability will go down. In this way you won't in this way you won't have to pay more cash for future. Just think, your year end is 30th September X8, and just after the 6 months of the year end, you have to pay this deferred consideration if you have seen the question. So you need to prepare cash for it. It's a risky thing. It's a risky thing. So we got 1 mark, 1 mark, and 1 mark. So my dear students, 7 marks. 4 marks I have taken from profitability, 3 marks from gearing, and then finally the limitation. Then finally the limitations. One limitation I told you many times in the class as well as, see, in 2007 you were given sorry, in 2007 you were given in 2007 you were given individual financial statement, but for 2008 it's combined. So the individual and combined financial statements are not comparable. Individual and combined financial statements are not wholly comparable. 1 mark, okay. And this other 1 mark is also very general. We do not have any information about the company operations. Very less data is given. Just one paragraph. They have not given you, even told you the product and many information is hidden. We do not have information about the company's operations, and if the company each sell different products in different markets, an analyst of each company rather than whole group would be more appropriate. Yes, better give us product wise information. If the company is dealing in many products, so we need more information to analyze. We need more information to analyze, right? Okay, so these are the limitations. You can also write more things about, like, you write about the P ratio, that what are the confidence, they have not disclosed the PE ratio, that what are the confidence of investors in this company. Many other limitations you can also write, okay. Now in the conclusion, if stopping company was acquired with the objective of having, see, apparently with the notes it looks like that parent company want to remove the competition. Parent company acquired S company was the competitor of P company. So why we acquire our competitor? Just to remove the competition, just to finish the competition. If stopping company was acquired with the objective of having bigger share of the market and improving profit, it has not yet achieved its objective. See, right now, right now, we have seen a decline. Okay, but one thing I can add here, if you want to add, there are different. This year only 6 months data of S company added in consolidation. Do you agree? Because this is the mid-year acquisition case. This is the mid-year acquisition case. So we added only 6 months data. We added only 6 months data. So wait for the next year. Wait for the next year. Next year you will see a full charm. Complete 1 year thing will be added next year. So next year there will be more clear picture. Okay. This can be also part of your conclusion. However, without reviewing the individual financial statement of stopping company, it is not possible to explain why this might be the case. Further analysis required to conclude the final decision. Very simple. And I have already told you that conclusions are normally political discussions. Have you seen the leaders of political party? How they never say final thing. They never say final thing. They just give general idea. Okay. So students, just think. Let me talk about the practical. I'm talking about average guy, the guy who has taken the classes. I think the first 5 marks was very easy. The second 5 marks practical was again easy. In the last 10 marks, if you score 5 marks, still it's 15 marks out of 20, which is very good. Very good. I'm applying prudence. I'm applying prudence. Okay. So I think you guys can score good. If you like this class, please comment on this YouTube video and also share with your friends, and best of luck for your exam. Last days are going on. Don't waste a single day. Be active on the WhatsApp group if something comes from my side, and take care. Bye bye.